Incremental analysis and relevant costing are terms describing the same concept. They both focus on identifying and analyzing the costs that are relevant to a specific decision or alternative, and disregard irrelevant costs like sunk costs. In essence, they both aim to determine the true cost difference between options. Here's a more detailed explanation. Incremental analysis, also known as marginal analysis, differential analysis, or the relevant cost approach, is a decision-making tool that focuses on the difference in costs and revenues between alternative courses of action. Relevant costs are costs that will change or be affected by the decision being made. They are also known as differential costs. Incremental analysis uses relevant costs to compare different options and determine the best course of action. Both terms emphasize the importance of focusing on future, cash flow-related costs that will be affected by the decision, and ignoring past costs or irrelevant overhead allocations. Discounted cash flow (DCF) analysis is commonly used in conjunction with incremental analysis. Incremental cash flow analysis focuses on the additional cash flows generated by a specific investment, while DCF uses those incremental cash flows to determine the present value of future earnings. Here's how they work together. 1. Incremental analysis. Identify the project or investment's incremental cash flows. This includes the additional revenues, costs, and capital expenditures associated with the investment. 2. Discounted cash flow analysis. Forecast future incremental cash flows. Project the expected incremental cash flows over the project's lifespan. Determine discount rate. Select an appropriate discount rate, often the company's cost of capital, which reflects the time value of money and the risk of the investment. Calculate present value. Discount the future incremental cash flows back to its present value using the discount rate. Evaluate the project. Calculate the net present value by comparing the total present value of the incremental cash flows with the initial investment cost to determine if the project is financially viable.